In this video, we're going to be talking about the book The Simple Path to Wealth by J.L. Collins. Hey, what's up guys? Welcome back to the channel. My name is Frank Malarsic, and I normally talk about investing in the stock market or specific dividend stocks I'm buying on this channel, but today I just wanted to talk about this book, The Simple Path to Wealth. I read it recently, and I just thought it was a really good book, and just wanted to share my thoughts, share the general ideas in the book, and whether I think those are good ideas or not. So make sure to like the video and subscribe so you stay up to date on all of my future videos, and we'll get right into it. So like I said, The Simple Path to Wealth is by J.L. Collins, and it's really hard to say what he is or who he is, just because he's so many things, you could say. Right now, he's pretty much just a retired guy that writes on his blog sometimes and wrote this book and enjoys life. So he basically had a variety of jobs throughout his career, and he had periods where he didn't work for a few years just because he could, and that's basically what he talks about in the book, and how he acquired the ability and the freedom to do that. And he just gives a lot of great tips in the book, which is all we're going to talk about. So the simple path to wealth, at least according to J.L. Collins, is exactly what it sounds like. It's pretty simple, to be honest. And basically what he says is you need to live frugally and save a lot of your income, and then go and invest that income. And the part about this that becomes super simple is what exactly you should invest in. So it's really easy to say, oh, just go invest your income or invest a lot of your money and you'll make money, but you need to know what to invest in. So he talks a lot about that, and basically he just advocates for a broad market index fund. And the one he talks about mostly is VTSAX, which is Vanguard's Total Stock Market Index Fund, but it is a mutual fund, and there's an ETF equivalent which you can buy within any broker, and that's just VTI. So those are basically the index funds he recommends for the vast majority of people, and he says basically when you are working at a job and earning income there, you should just be putting as much as you can into VTSAX and just investing constantly, like every week, every 2 weeks, every month, whatever works best for you. And then he also does throw in another one called VBTLX, which is Vanguard's basically total bond market index fund. And he says when you get a little bit older and are looking to maybe retire, or actually live on some of your investments, you might want a little bit of a smoother ride, since the stock market is pretty volatile. So he recommends, I guess, putting a portion of your portfolio, maybe 20 to 30%, into that fund, and then keeping the rest in VTI. So that's the basic strategy that he talks about, but there's definitely a whole lot more to this book than that, because he talks a lot about other things that are related to investing that are going to affect how you can retire or when you can retire, and all of that. So some of those things that he talks about are like how to transition to a retired state, or when you can do that, or he talks about why this strategy that he advocates is the best in his eyes. He talks about tax advantaged accounts and how to use those best, and which ones to use in which situations. He talks about some other stuff like required minimum distributions, which occur in tax advantaged accounts. So there's a ton of other great information in there. I'm not going to go into depth into all of it because I think you should read the book, but that is basically what he talks about. So what do I think of this basic strategy? I think it is certainly not going to fail as long as US companies continue performing well. Because the VTSAX that he recommends, that's just for US companies. He does talk a little bit about international exposure and stuff like that, but the main point there is a lot of these big companies in the US do have a lot of international exposure, so you're kind of getting international diversification there already. But the big thing that he says a lot of the time, and basically the reason, I guess, that this path that he suggests is the best way, is because he doesn't think it's really possible for individuals to pick stocks that are going to outperform the market in the long term. And I definitely have a little bit of mixed feelings on this. On one hand, I kind of agree with it, and I can say I agree with it because I have most of my investments just in index funds, and the individual stocks are just a smaller amount of my portfolio that I'm just kind of having a little bit more fun with and being a little bit more active with. But on the other hand, I do think that a lot of times individuals can have an edge over the institutions, because one of his reasons basically is that, well, there's all these professional fund managers out there. Why can they not consistently beat the market? And basically, when I hear that, I think back to kind of what Peter Lynch was talking about in his book, which is that there's a lot of disadvantages that fund managers sort of have. They have to stick to rules. They have to, listen to the people who are investing, or at least, if people want to withdraw their money from the fund, they have to be able to provide that liquidity and things like that. So there's kind of some restrictions there. Another thing is, for example, if the fund is super big, they can't just go buy a whole company, and they have to be wary of how much of a company they can buy. And, if it's a small company, well, that little investment isn't really going to affect the overall performance of the fund. So then, the amount of companies you can even invest in kind of starts dwindling down for some of those bigger fund managers. So a lot of those things that Peter Lynch mentioned really made sense to me as to why the individual investor can kind of have a leg up in some circumstances over the fund managers. So I definitely think what he's saying is, a fair and valid argument, and I think it can definitely be argued very well and convincingly that that is true, that most people can't outperform the stock market. And the data suggests that most people, I think, average like a 2 or 3% return in the stock market, who are just individual investors. So that's certainly evidence of that. But I don't like to say, well, I'm just the average person. I kind of like to think I'm able to do a little bit more, or I like to think that I can try harder or learn more than most people. So that's my position on it, and I'm not saying I can beat the market with certainty. I'm not saying I'm going to do that every year, but at the same time, I think that I'm just investing in super quality companies that are going to do very well in the long term. So I don't think I'm going to, lag the market substantially. So if there's a chance I could beat the market without having much risk of not beating the market or lagging the market substantially, then I think I will take that, and not worry about that too much. But the one thing I do like about index funds, just like VTSAX, which he recommends, is just how passive they are. You really don't have to worry about it too much. You just kind of put some of your money in there every month or every week or whatever you want to do, and not worry about it. And with individual stocks, you kind of have to manage it a lot more. You have to really pay attention, in my opinion, to when you're buying, because stocks are going to go up and down and be at more attractive prices or less attractive prices at different times. So it's definitely a lot more active, and I can definitely see myself, if I get a lot busier in life at some point, if I get older or something like that, that I will just not want to be as involved, and be a little bit more passive. And at that point, I would not see a problem putting my investments more heavily into index funds, just because I think that would be a lot easier, and I would still get pretty much the same returns, if not a little bit better or a little bit worse, but not much difference. So overall, I really enjoyed this book. I learned a ton of things to consider when investing. I really didn't learn a whole lot about, VTSAX. I was already aware of that, and stuff like that. But I did learn about a lot of other things that can affect your investments. I didn't have a super good understanding of all the different tax advantage accounts and the different reasons for them. But he talked about them very in depth. And gave a really good overview of that. And then I really didn't know much about the required minimum distributions that come along with some of those tax advantage accounts, and he talked about that a lot as well, which was super helpful. So there was a lot of good info in there that maybe I won't use right now, but in the future it could be very useful. So if you do want to pick up a copy of the book, I'll leave an Amazon link in the description below, and if you do use that link, I'll receive a small commission, but it should not be any extra cost to you, so I'd really appreciate that. And I'll also leave a link to JL Collins' blog as well if you want to check that out. There's a ton of great info on there. So if you guys have read this book already, I'd love to hear what you think, whether you agree that individual investors can't beat the market, or what have you. I'm probably not going to follow his exact advice, like I said, but I definitely see that his advice is very good for everyone, and I think that a lot of people would get a lot of benefit from reading this book. So and I will see you guys in the next one.